Ever wonder how your everyday spending habits, like your morning coffee or that new gadget you just bought, could be linked to the ups and downs of the stock market? It sounds a bit strange, right? But there's a fascinating economic idea called the Consumption Capital Asset Pricing Model, or CCAPM, that connects these two worlds. And today, we're going to break it down in a super simple way, so you can see how your life as a consumer and an investor are more intertwined than you think. So, what is this CCAPM thing? Let's start with something you might already know. The regular CAPM. It tells us that riskier stocks should offer higher returns to convince us to buy them. Makes sense. But CCAPM takes a different angle. It says that the value of an asset isn't just about its own risk, but how it helps you smooth out your consumption over time. In simple terms, it's about making sure you can keep buying the things you need and want, whether the economy is booming or busting. Let's imagine two scenarios. First, the economy is great, everyone has a job, and money is flowing. During these good times, you're probably spending more freely. An extra dollar in your pocket is nice, but it doesn't dramatically change your life. You're already comfortable. Now picture a recession. People are losing jobs, and everyone's worried about money. In these tough times, an extra dollar is a huge deal. It could mean the difference between paying your rent or not. That dollar is way more valuable to you during a recession than during an economic boom. This idea is called marginal utility of consumption, and it's the core of CCAPM. So how does this relate to stocks? CCAPM suggests that the best assets are the ones that pay off when you need the money most, that is, during bad times. Think of an asset that does well when the overall economy is struggling. Let's call it a recession-proof stock. Maybe it's a company that sells essential household goods. People buy their products no matter what. Because this stock gives you money when that money is most valuable to you, you'd be willing to accept a lower return on it. It's like a form of financial insurance. It helps you keep your consumption stable. On the flip side, consider a stock that does incredibly well only when the economy is booming. A luxury car company, for example. When times are good, their stock soars. But during a recession, their sales plummet, and the stock tanks. This asset pays off when you least need the extra cash. Since it doesn't help you during the tough times, it's considered riskier from a consumption perspective. To convince you to invest in it, this stock must offer a much higher potential return to compensate you for that risk. So CCAPM gives us a powerful new way to think about risk. It's not just about how much a stock's price bounces around. It's about when it pays off. Does it help you when times are tough, or does it only add to your wealth when you're already doing well? According to CCAPM, an asset that helps you maintain your lifestyle during a downturn is less risky and therefore should have a lower expected return. An asset that is pro-cyclical, meaning it does well only in good times, is riskier and should have a higher expected return. This helps explain some market puzzles. For example, why have stocks historically offered much higher returns than bonds? CCAPM would say, it's because stocks tend to do poorly during recessions, exactly when we need money the most. That extra return, the equity premium, is our reward for holding an asset that's risky to our consumption patterns. So, next time you're looking at your portfolio, don't just think about volatility. Think about consumption. How would these investments perform if the economy took a nosedive? Would they help you weather the storm, or would they sink with the ship? Understanding CCAPM adds a whole new, practical layer to your investment strategy, connecting the dots between Wall Street and your daily life. It's a reminder that at the end of the day, the goal of investing isn't just to get rich, but to build a life with financial stability in good times and in bad. I hope this breakdown made this complex topic a bit clearer. If you found this helpful, please hit that like button and subscribe for more content that makes finance easy to understand. Thanks for watching.